Good morning, everybody. I hope everyone is well and can see and hear us. If anyone's having any technology issues, please just drop a message into the chat to let us know. But I'm assuming you can all hear me. Welcome to this morning's talk with Paul from 8am Global. We're going to be dissecting, or at least trying to understand some of the nuances with regards to evidence-based investing. We're, I think, all seeing and hearing a lot more of these words and providers saying they have an evidence-based approach versus an active approach or a passive approach. But actually, what does this mean? What are some of the advantages? What are some of the disadvantages? What are things that you as an advisor need to understand and know, and actually, I guess, be able to articulate to your clients? We'll also still look at some of the tools and techniques that the guys at 8am use or to construct optimal portfolios in terms of leveraging both active and passive management styles. If anyone has any specific areas that they want to cover or any questions we have as we go along, please do use the chat box. I'll keep an eye on those, and we'll go through any questions if they're relevant at the time, or we'll come back and we'll do a Q&A. Today is most definitely not going to be death by PowerPoint. We've got a few slides to share with you. This is going to be a discussion, relaxed. So if you've got questions, please ask them, because Paul and I will then discuss them. Morning, Paul.
Hey, all right. How you doing?
Very well, thank you. Very well.
You're obviously, people will be aware that you're not at your conventional standing position in the normal room.
I'm not in my conventional standing position. I'm not quite sure what to do. I'm sitting down. I've been on the road all week, and I can't. Yeah, it's feeling very strange. I'm not standing at my desk at home all day. But yeah, I'm in the lovely Merchant Hotel in Belfast at the moment.
Wonderful. How are the roadshows going, buddy? Are they all going well?
They've been really good, actually. Some really positive feedback. Lots of good questions. Yeah. And as anyone who goes to any of these webinars will realise that whilst the content technically is the same in a webinar, they're never the same, because different people have different questions, different needs, different business models, which is why, whilst there may be 20 sessions, they will be 20 different sessions.
Yeah, right.
But yeah, no, all good so far. Week one of the roadshow done, and 3 to go.
Perfect.
Ask me about my waistline at the end of June.
Well, there we are.
So where would you like to kick off, Paul, in terms of, from the evidence-based side? Do you want to give a little background in terms of, I guess, where things are at, some of the fundamentals with regards to, where you see the nuances between evidence-based investing versus, and some of the complexities? Where do you want to begin?
Yeah, we can start there. I think for me, some of it comes down into the kind of the phraseology, really, because evidence-based investing, the kind of the definition is always about using long-term historical data, using academic research, and sort of applying an evidence-based approach. I think it's really wide, because actually you can pretty much get that vaguely into a lot of propositions, and recently over times I think it seems to have gone hand in hand with the idea that evidence-based is passive only. Or it's all about a kind of a low cost passive only proposition is what evidence-based is. I think a lot of it also leans towards the fact that as we'll look, and I've got some slides to sort of go through, the idea is that evidence has historically shown that active fund management is incredibly inconsistent. History has shown that there is an inconsistency in being able to select active funds that can add value into a portfolio. So evidence-based investing means don't bother with them at all. Whereas there's also a growing body of research that says, well, actually, evidence shows and academic research shows that there is value to be had within active funds. There are trends that are there, and perhaps evidence-based is an extension in terms of phraseology to looking at trends and saying, well, is there a way of sort of using both approaches or incorporating both of those, and it's still being something that is a low-cost evidence-based proposition? So I think really for me, it's just understanding some of the kind of the nuances in how it's described and what it really means, and perhaps what it means to us.
So why do you think? Because everything you said there makes sense to me. But I think, why do you think we've ended up with this sort of surprising complexity of how of why it's being defined that way? Because let's be honest, if everybody went down the passive route, the markets would fail. If everyone's trying to buy every single company on an active approach, then there's always been this hybrid approach. I'll say there's always been, but there's quite often been. But so why have we got what I'm seeing and hearing is people saying, I don't understand what evidence-based investing is. Where has this complexity come from?
I think it's sort of come from the variety of different approaches. I think it's exactly in the fact that it's a catch-all term that's been, applied to a variety of different propositions, and it's kind of the phrase of the time. It's something that people are seeking. Is they're looking for an alternative, perhaps to traditional approaches that have failed or have been inconsistent, or they've had great short-term results and then a bout of unsuccessful kind of performance or results or outcomes from a provider. So I think there's a lot of people that are seeking solutions that do follow an evidence-based approach, which is why everybody's sort of keen to have that badge, or at least sort of be able to apply that badge to their solution. And
given the trend in terms of passive indexing is growing in popularity.
Yeah.
Where do you see evidence-based investing or active investing really actually stepping up and outperforming the markets?
Well, I think for us, really, there's kind of a way of saying that every sort of style has its moment, and really what you're getting with these funds is exposure or so active funds are giving you kind of like a concentration. They're giving you a concentrated exposure to a particular theme or to a particular trend, and passive funds are giving you sort of a more broad exposure to the market itself. And lots of sort of propositions still might use passive funds, but would say, well, actually, what you can expect is some kind of short-term tactical defensive mechanism over the top to protect against downsides, whereas really potentially what they're getting from a passive solution is, you are getting one-for-one market returns. So perhaps that is what should be viewed as maybe more of the defensive concentration, is the holding of passives is market returns, and active funds are being able to sort of sit on or take advantage of particular themes or concentrated movements in the market as certain sectors turn or regions turn, and they start to demonstrate or deliver value. Because I think otherwise there are still huge amounts of value being generated that are being left outside and left on the table, as it were.
And are there any real examples of this? And I was just thinking, one thing in my head as you were saying that is, I guess the difference from what you're talking about here is in terms of this active approach, hybrid approach, evidence-based approach. And we started to take out some of the risks of fund manager biases and actually management biases, where the particular manager of the fund has a particular preference that isn't necessarily evidence-based; it's conviction-based.
So this is where it starts to get very interesting and exciting for somebody as sad as me. Is that actually what we're talking about is an acknowledgement of that exists in the active fund world, and you can't. When it comes to active fund selection, it's very, very difficult to for fund managers to sort of mitigate the effects of the human bias inherent in their proposition, right? And we've done other things on this for you guys as well, just specifically focusing on sort of the mitigation of human bias itself. But what we're talking about, it's probably useful to show this idea. Okay, so the main body of evidence suggests that there is a huge amount of inconsistency in active fund selection. Okay, so the idea is, if you look at the little book of Common Sense Investing, that less than 1% of US equity fund managers were consistently skilled enough to be able to outperform their benchmark over a 36-year period. So that's a massive stat. It's very compelling. It's very strong. And the research goes to show, well, actually, it's this kind of red area here where we're saying the consistent skill set is very, very low. But actually, really, what this is kind of also revealing is this wider blue area where you have got managers who are able to deliver market-like or some ability to outperform. So that is happening. And what we're really talking about is kind of, if that's the case, if we do have managers that are able to outperform, but that is inconsistent, what we're looking at is a wider study. So Essentia Analytics, really cool group of people. What they're doing is looking at this. They've looked at sort of 4,000 models and tried to analyze the trends within what they call sort of alpha decay. So the idea is that obviously there are trends to fund managers delivering alpha. So within that set of that 1%, what's actually happening is each sort of manager as a trend is building alpha, and that builds very, very quickly. Then what's happening is that the fund is plateauing, and it's starting to mean revert already. It's starting to give you that market-like performance, and then it completely sort of tanks. So the idea is if you're looking for a single fund manager to consistently deliver, actually the trend is exactly this. They're going to sort of cycle up, they're going to plateau, and they're going to mean revert. And that is the effect of human bias on top. And I'll pop a link to these slides in afterwards so people can have a play around with. So what we're saying is, well, if you can acknowledge the fact that there is alpha being delivered, but yes, it's inconsistent, what we really need is a way to sort of screen for it, because what their research sort of basically shows is that if the fund manager is able to exit and sell their position, or if you're able to sort of do it within the 50th or the 75th percentile. And before I hit this button, I'm going to apologize because I put these slides together and it still has a Star Trek meme in it. But basically the idea is within these two sort of windows, that's when it's possible to kind of lock in the value effectively. And that's where it's possible to deliver performance that says, actually, okay, value has been evidenced. But if you hold on to the position for too long, obviously it is going to sort of mean revert. And that's the issue with the consistency of active. So the human bias thing is really just about exiting. So it's having an emotional approach to it. And it's going, okay, well, actually, the returns that can be generated, if you look at this line here, which is sort of passive, market neutral, sort of 1-for-1 tracking the market, what's usually happening, because people follow the way through, if you can see my mouse, I don't know, is the yellow line here, showing that generally as you follow it through to the course, you're losing the value and you're going through. But if you're able to dispassionately exit within that window, the hypothetical performance of selling at peak, is well above the baseline, which is kind of what we're talking about here. So there's a couple of really cool research papers from Essentia that talk about this generally, and the idea that by reducing human bias from a proposition, there's huge amounts of value to be had and more consistency to be had as well.
So have you got any examples? Because again, it makes perfect sense. Is that nothing worse than the manager holding on to the asset for too long and then losing all the gain and the alpha that was there. But have you got any examples or any conditions where you've seen this work specifically?
Yeah, so I think we've got a few examples where within the kind of idea of fund selecting, I brought one up earlier, so let's see if I can pull it up here. Yeah, I think what I was looking at was Premier Might US Ops after the SPV issue. So it's one of those things where it fell in performance and people felt that bank prices would shoot back up again. And we sold out of the position dispassionately based on the evidence that was presented in the model, the multi-factor model, but the prices didn't. So it was an effect of people, the human bias, the idea of this gut feeling, this decision that things would come back again, was massively strong, but the data and the evidence didn't support that. So sort of actively, dispassionately selling the position added huge amounts of value into the kind of the context of our AQ MPS, because we weren't acting on gut feelings and the idea that something could come back in the future. If it did, great, we'd have it, but that didn't unfold.
When you're starting to think about the active managers that you might want to work with, what are the red flags? You know, what puts you off buying a particular manager or a particular fund based on some of the stuff you've been talking about there?
Well, I think for us, you know, the data set really, the world is changing so much, and on a on a much more of a global basis now. So for us, the idea of really a selection window, the maximum for us is within this kind of alpha cycle, this kind of 3 to 5 year window. So the idea of long-term performance is less relevant because the markets beyond that are really starting to not reflect the world that we're in at the moment. And red flags when it comes to our model. So we basically have this kind of multi-factor setup where we look at some sort of core criteria. So there's sort of responsive, defensive, and core, and we look at it on a relative basis. So it's all objective. There's no individual positions. We just know how managers are performing against each other within a particular sector, so that we're able to identify consistency and trends. And the idea is that effectively within that data set, so if anyone's interested, we're looking at sort of short-term triggers that are telling us the position against the current market trend or cycle in terms of performance, and then we're balancing that with risk-adjusted measures that look at how the funds are flagging, what the beta, the tracking is, what the alpha is being generated, and all of these things will give us a screening criteria. And effectively, the red flag for us is not necessarily an individual score or an individual element that highlights up, because this is in its nature a multi-factor model. What it really is something falling from a top 10% position into anything less. So we would actively review, or we would actively sort of start to consider funds and their position within the portfolio if they're in the second decile. Anything below that, so sort of second decile beyond, is automatically sold. So the red flag for us is anything that starts to drop within its positioning relative to its peers, and that's looking at consistency and sort of like a feeling of a momentum trigger, because the idea is there will be additional flags that show us how well or how often this has appeared within our data set in the past, so that we know, okay, actually this is a one-hit wonder. This is something that is consistent. The manager is likely to or has proven that they would operate in this way historically, and that all has a factor within the algorithm. So the red flags for us are very, very simple. If it falls out of the top 20%, it's gone. If it sits within that 10 to 20%, then we have the ability to sort of, as a committee, actively come out of it, but we wouldn't automatically. Does that make sense?
It does. But then on the flip side,
yeah,
clearly this is about evaluating performance and predicting future outperformance. If you've got some red flags that will determine when you decide to sell, what determines when you're going to buy? So is there anything in particular, be it qualitative or quantitative, from from your perspective, when you're looking at managers, that you think, yeah, we think there's some factors here that are going to help us predict future outperformance? And I guess from a qualitative perspective, we're taking the data not out of the equation, but we're not looking at quant. What are you guys? How do you build that in terms of the mixture of qual and quant?
Well, the difficulty there is that it's this idea of predicting. The idea that you can position a portfolio to grab an active fund just as it's about to deliver something, and that is absolute horse bananas. I think any.
Well done.
Thank you. Not had enough coffee, but just saved myself there. I think it's really this idea of like, okay, any kind of like short-term tactical positioning or any kind of solution that says they're able to predict or they're able to grab the latest trend before it happens is on some kind of Scooby-Doo dust. Because really what we're saying is, actually, with something like this, you can't speculate. You have to accept that you're not going to capture the day 1 to 6 month or 3 month, that kind of 60-day, 30-day cycle. It's not going to happen, because that is the magic realm of nobody knows. And if they tell you they know, they are talking, absolute rubbish. The idea is that what you can do is you can objectively capture the trend as it starts to establish itself. So for us, a selection isn't really about predicting what's going to happen. It's about evidencing what is happening, and then taking advantage of it. So it's saying, what is the trend? Are we thematically concentrated in that to leverage it, and doing so, not about predicting.
So what are we saying here? And I guess this has always been the criticism of active management, in terms of, no one can time the market. And if they say they can, they're talking horse bananas, which is a new one on
horse bananas. Yeah, you can keep that.
But what we're saying here is actually, we're not trying to time the market. We know we're not going to try and time the market. We're going to wait. And I'm just trying to, I guess, articulate in my head where evidence-based investing comes from. We will buy when the evidence is there to buy. We know we've potentially missed the big upside, but actually the data is now telling us we need to be in this particular market, this particular manager, this particular asset class, because of whatever it may be. We're not going to try and time the market, because that's the human element, which is, we know is wrong.
Exactly right. And actually, when you say the big upsides, the idea is that actually, if you have a mechanism that can do this consistently and capture this blue bit here, what it will do is it won't be shooting the lights out all the time. So you'll see, great, if you're leading on performance, something that is top quartile now, even from an NPS proposition level, it doesn't happen consistently. It will happen for maybe 1 or 2 years, and then it will mean revert or worse. But really, the idea is that you can incrementally add small amounts of alpha. It's incredibly boring. It's not very exciting. But what it does do is, cumulatively compound over time, so that the actual portfolio proposition delivers huge outcomes, for those that sort of are investing through various different market cycles. It really is the idea of not timing it. We're just capturing what can be evidenced, using it, dispassionately getting out of it. And it, for us, it's not rocket science. It's just the idea of, we have to avoid this human bias. And there's this idea that, when you say a proposition is using an active fund, that actually what they're doing is trying to do that, to, be clairvoyant and essentially go, we are selecting this because all of us have sat down in a room and we've all decided that this fund is the future. None of that, thanks very much. If it doesn't come into the data set, it can't be used. In the same way, you talk about qualitative research. I think for us, the qualitative research is secondary. If the data delivers, we've got a few other flags. Is it available on a platform? What's the fund size? A few of these other flags beyond the core measures that enable and tell us whether it fundamentally can be used in a model. But then the qualitative stuff is very different, because the conversations are, you are being selected based on these fields. And there's almost kind of then a different conversation, because once they know it's a quant-based decision, they can, sort of loosen the tie and undo the waistcoat type of thing. But it's a cool way to approach it.
And is this one of the reasons why? Because cost is clearly a factor for people, and there's always been a argument for and against active being as expensive as it is, and the passive being as cheap as it is. And actually, from what I'm seeing, the evidence base, sits in between. But it's because we're looking at this from a data perspective on quant versus qual, and the amount of research that a truly completely active manager that isn't necessarily looking at the quant will be doing. Is that how you can keep the cost down? Is that, is it because the data is actually driving this, which then drives the cost down?
100%. I mean, our investment committee time, in a normal cadence. So obviously we're doing this every 2 months to make sure it's optimized for the current market cycle, is like an hour. So it's very quick, and usually that's just a case of reviewing the data set and looking for anomalies, doing a kind of a human sense check. But really, it's such a time reduction that the efficiency of producing something like this and creating reports that then also just say fund is up, fund is down, fund is in, fund is out, it is super, super simple, not just to produce, but for people to understand. So the whole thing, means that it can be run very efficiently and keeps the costs right down. I think that's the idea. Is it doesn't, and it shouldn't, cost huge amounts to be able to have a proposition that uses active in some way.
And so beyond outperformance and beyond cost, are there any other benefits of taking this kind of approach that potentially advisors don't know, don't see, or overlooking? I guess what other benefits come with this type of approach?
I think there's a lot that comes from the cost and the clarity and the consistency and all that kind of stuff. I think sometimes it can be tricky, because if the mindset is fixed on performance, if you have periods where there isn't any demonstrable or demonstrable value, and you look at the last few years which have favored passive funds very, very well, then what you will see is more market-like returns. So it's really not, okay, what are the hidden benefits? It's more like what is actually a proposition like this, or an evidence-based proposition like this, doing is it's leveraging the existing market conditions to get the best out of it. And you will see that you will take a more passive, a broader market exposure in times of uncertainty. So it's really just being aware that this isn't a magic box. It's not a magic proposition. There will be times when you'll fluctuate between sort of like top quartile, second quartile. So that kind of performance, it's not about delivering the best returns all the time. It's about consistently delivering some return, in all periods, and never tanking, which is really the kind of idea there. So I think it's more about having that stability and that confidence in discussing to a client with a proposition that just, is designed to be a steady hand on the tiller,
So do you think, and again, I'm just thinking about this from a firm's perspective in terms of which clients, in which scenarios this approach could be useful. If we're saying we're not trying to outperform the market in all occasions, we're trying to deliver some performance in all occasions, trying to mitigate some of the volatility in some of those pieces. Do you think this type of approach is right for some clients in some circumstances? Because clearly, if you've got a client who's got a huge appetite for risk and really wants to shoot the lights out, and you're trying to mitigate some of that risk, that's not going to suit their appetite. So do you think firms need to think about this in terms of when this approach can work for particular segments, cohorts of their clients?
Yeah, 100%. But then again, I mean, you have to remember that this solution is risk graded up to certain levels. So, you will have something that will suit profiles, even up to like proper 7/8 full global exposure. So that is there. The risk appetite is there. What it's kind of saying is that, yeah, I guess if you want somebody who is taking more of a punt on things and wants more of a speculative approach, then this isn't suitable, because what this is saying, well, if you give us a risk budget, then we will operate within that. And that may mean that you've obviously then got more of that equity exposure. You've got more of the fund selection, more of the active elements happening. But really what it's saying is that it will have an element of consistency to not drop off a cliff. So you will exchange some of the upside for that. So it's really just about having the conversations for the element of short-term risk, and whether or not those speculative clients are happy to take that on the trade-off for the potential to be top 1% for a year. This isn't the proposition for those people, I don't think.
So putting you on the spot now. Give us an example. What sort of, if you're thinking of this from a weighting between active and passive, based on a client or an individual investor's risk tolerance, risk goals, whatever they may be, how do you approach that? How do you get that balance? And is that something that you think you guys need to be controlling, or is that something you think the advisors need to be controlling?
It's an interesting one. So from our perspective, the balance is obviously delivered by the data underneath. So if, for example, they're kind of 50-50 right now, and that's led by the fact that there has been this kind of historical period of uncertainty where we've now got some more thematic trends evidencing themselves. That will change. So I think, really, in terms of exposure, we don't, or sort of weighting allocation, it's not a fixed element that says, it has to be this. The idea is that you will dip in and out of broad market exposure and concentration based on what the evidence is demonstrating. And we kind of feel like that's very much within our wheelhouse from an analysis point of view and the data set that's there. Really anything else in terms of, okay, there should be additional oversight to increase exposure might be if you've got a client who has a particular requirement for cost, in which case, anybody who's just pure cost above all else, again, this wouldn't be for them. There are other passive solutions out there. There are tracker funds, multi-asset manager funds that can deliver that. But from a proposition perspective, it will be based on the kind of empirical data that we see within the multi-factor model.
And then what sort of factors from a practical perspective will you be taking when deciding how to construct the portfolio with regard to that balance of active and passive? What we say the data, what are the factors, what numbers are you looking for to be able to go, okay, we actually feel that buying the market right now is where the value is, versus actually we think that we need to be going into the active market and buying the manager?
Yeah, right. So the idea is to look at the peer group. So we will have lots of sort of good MPS peers and multi-asset peers who are making sort of tactical asset allocation choices or making exposure and concentration choices. And what we're really trying to do is sort of sense check our risk level allocations against what our peer group are doing, to make sure that we're positioned within a tolerance. So we take that as an inference to sort of make slight tweaks to, never aggressive, never huge, maybe like 2 or 3%. And that will really be an inference to say, we are looking at peer groups to make sure that we're operating within a kind of almost like a crowdsourced or wisdom of the crowd kind of ability. Because again, we are not a house that has that kind of asset allocation construction within. So we're taking that from third parties like Dynamic Planner, EV, Defacto, and we're taking that as a peer group and then combining that with the thoughts of our peers in the market from multi-asset perspective, and then really just kind of creating what Ash likes to call a floating asset allocation, because it has this ability to kind of tweak slightly towards or away from based on the peer group average.
I'm going to put you on the spot now. Just because this particular conversation in terms of the different approaches, the different methodologies, the different views of all of the risk profiling tools that you've just been talking about there has come up on the retirement income roadshow, and actually some of the limitations of those tools when trying to build portfolios. How do you get around that? Because everyone on the webinar will use some sort of tool, I assume. They will either like it or not. It tends to be that people aren't necessarily happy with it, but they still use it because they think they've got to. But something the FCA picked out from the retirement income thematic reviews, that actually firms don't fundamentally understand how those tools work, so don't understand the limitations. That must be an absolute nightmare for you guys, because if you have a particular approach that you want to take, but you're being told by a risk profiling piece of software that you have to do it this way or you have to do it that way, surely that becomes very difficult to get to deliver what you want to deliver when they're all so different.
Yeah, right. I think, and They are very, very different, and you'll know from history, having worked at a couple of them, that there's a huge breadth of difference in terms of how they approach the asset allocation that they ultimately deliver, and not just that, but the way that that is delivered. So, for example, as an advisory firm, you may have access to, or you may be sent a certain asset allocation which is not as granular as the asset allocation that can be delivered to an asset manager or a DFM who is mandating or partnering or doing something like that. So you have a disparity not just in the calculation methodology, but also the granularity of the asset allocation that's served up at the end. Then you have to factor in the kind of the frequency. So some are updating it monthly as a look forward. Some are doing it quarterly in arrears, for goodness sake. So you're already kind of limited in terms of your ability to deliver to the current market conditions based on something which is sort of lumbering along at quite a slow pace. So from our perspective, you can only really use that as a starting point, which is why we have to look at a long-term strategic asset allocation versus effectively short-term. So we can't wed ourselves specifically to a fixed asset allocation because, again, horse bananas. What you can do, though, is you can effectively use a bit like a blending of active and passive, a blending of the views of long-term peers. So that's why we have to use several. And then also the views of short-term asset allocation. And again, we will have to use several in order to inform what the best positioning is based on, things that are doing well and the trends that these guys are viewing. Because funnily enough, there are a lot of similarities between the outcomes that come out, as well as, some divergences and those that we don't agree with. So yeah, it's something that we look at
what
very
about when you?
seriously.
I was going to say, because what about when you then get into the difference between risk adjusted and risk targeted? In terms
Mhm.
of having to sell out of an asset that you might not want to because of the way it's being viewed by the profiler. How as an evidence based manager do you get around that, or how do you keep within the tolerances that you're trying to keep to?
Yeah, well, exactly. I think the idea is that so for us, what we do once we make any portfolio iteration changes is we'll send the portfolios back before we hit the green button to make sure that they sit within the risk tolerances of the risk profilers. And again, what that may do is be viewed more as a kind of a rolling volatility or a rolling kind of risk target, with us having some flexibility to agree or disagree with a strict asset allocation adherence, because that's not what we're about. That's something that historically has never proven well, because it doesn't give you the ability to decouple yourself in times where common sense prevails. So for us, it's more about that ability to resubmit and revalidate that changes made will not affect the rolling volatility or the rolling projected volatility. And that, again, we have to do within the context of the providers, because some can instantly give you a thumbs up and some will give you a thumbs up in 2 quarters time. And I think that becomes a problem where you will have firms that work within the evidence because they will know that there is a delay. So there is a period of time they can do whatever they like before it has to be submitted. But yeah, we prefer, the kind of the repeatability and the regularity of doing it on a bi-monthly basis.
We gonna name any names?
Do you know what? I'm not. People know me. People know where I've been. It's fine. Would it be helpful for me to name? I don't know if I'm going to burn bridges, Christian.
Okay, let's not name those. But something, and again, just as a byproduct, this is something that's coming up an awful lot now. And as I say, as part of the FCA's thematic review into retirement income planning, they picked up some of the inadequacies, inconsistencies, inefficiencies within the risk profile and tools and asset allocations, and having a conversation with another manager this morning who was saying, they were to build a decumulation strategy, they were told they had to hold 15% of high yield bond. They were like, we don't hold a single high yield bond within any of our portfolios, because we can get the same value for an investment grade bond without taking the risk. But they had to, but to get it to decumulation badge, they had to do that. Which again, it's but I don't think people understand, necessarily firms understand the work that goes on behind the scenes with you guys to be able to build these things and actually get it within the tolerances that firms are saying they want to. So something I'm going to do on the back of the roadshow is actually trying to sit down with some of these risk profiling tools to try and understand some of the complexities and limitations of them, so that we can be clearer and firms can actually understand if they're using a particular tool, why they're using that tool, and does it work for their business, or should they be looking at a different one which might have a different approach? And they're all
100%.
If they're all consistent, they'll all be wrong. So they all have value, but it's got to fit into whatever your investment approach is.
It does, and this is something that we talked about in my time at eValue, because what they did very well was incorporate their stochastic framework within not just the generation of an asset allocation, but then also in the validation of a cash flow. So if you made iterations, or you had something else like guaranteed income, for example, you'd be able to see not necessarily what effect that has on the risk score, which you could see, but more importantly on what the actual client's capacity for loss, or their ability to achieve their objectives were, which is the other flip side of the coin. So there's a whole load,
and also the efficiencies within the portfolio and so forth, in terms of that is creating a certain element for you, which means you can do something different with something else.
100%. So yeah.
So clearly, this is what you guys do in terms of building portfolios, constructing optimal portfolios. How are you doing it? What sort of tools and techniques are there for doing this? And is there anything you can share with us?
Yeah, of course. So we use it sort of goes back to the good old days, but we use basically we have a proprietary algorithm for weighting our multi-factor model, but it's very easy to sort of replicate or infer elements of this. I think in a similar way that you have to be aware of what assumptions go into an asset allocation tool, I think people have to be aware of the assumptions that they use within portfolio analysis. So as an example, when using FE Analytics or Morningstar, not a lot of people I'm aware of have ever changed the risk-free rate that's used within the calculation for any measure within the system, and the risk-free rate's historically been set at the default of 3.5, and whether or not that's been historically correct over time is a question for the wider world. But it's basically, okay, if I'm going to use a tool set, I think there are loads of really good analysis tools out there for evaluating performance. The idea really for us, the thing is, we use a lot of database work. We use a lot of APIs that come in to deliver us the data from FE, from Morningstar, so we can look at it at a kind of a wider context, because each one has their shortcomings and their pros in terms of either the exposure data underneath, the granularity, or the calculation methodology. So it's looking at the sources, it's looking at the underlying data sets. We use a lot of MS work, so we use a lot of Excel and we use a lot of Microsoft database. They're not fancy tools, but we are able to use them with VBA and with API integrations, so that you literally get the best that you can from them. So it's really just kind of looking perhaps at some of the tools that you have in order to maximize the usage.
So we're saying it's not necessarily the quality of the tools, it's the quality of the toolman, as in are you geeky enough to be able to build the spreadsheets and the databases to extract the data exists. It doesn't necessarily need the fanciest tools in the world. You just need to be that geek.
I think so in some ways, yeah. Or just not necessarily be a geek, but just be open to looking at what some of the shortcomings in the data set could be, or where perhaps some of the assumptions lie, in the same way you would evaluate a risk profiler. And referring to that because it's something we've just spoken about, but it's we reduce a lot of the noise in the analysis by making everything relative. So you can get misled. Human bias can come in even in your analysis, and that could be, wow, look at that huge number there. And by making it relative and just reducing the noise, that can be a fantastic way to do it. And all you need to do is just change one setting in FE, for example, to make a table relative, rather than looking at absolute values. And that can be, you know, a massive change in terms of how you digest and how you evaluate the information within the table itself.
You've said that, you know, the idea of using active management, or the inconsistencies of active management, is an advantage. What do you mean? Can you elaborate a little bit on that in terms of, you know, are there specific strategies for doing this?
Yeah, it comes back to the slide that's been up here, for example, is the fact that if we acknowledge that there's a life cycle to alpha, you know, it's going to come, it's going to be there, and it's going to go. Active managers, that's what they're able to do, or hopefully do, is generate some alpha. Whether or not they do it consistently is kind of irrelevant, because in the same way that whether they've done it through skill or luck is irrelevant. It doesn't matter if you're able to leverage the fact that there is alpha being generated, and you don't really care how it's done, but what you want to do is screen for it and use it when it's there and evidence it when it's there. That's kind of what we really mean, is leveraging the kind of the inconsistencies. So going, okay, active management is inconsistent, but actually what that means is there are trends, and there is alpha to be had, and there is some element of gain to be had, as long as we can capture it in a dispassionate way, and we can you know, build in mechanisms to evaluate, add it in when it's there, and bin it off when it's not. That's really the idea.
And obviously, I'm not asking you to give us a future prediction of where you think markets are going, because it's all about the data. But what's the data telling you right now?
Well, yeah, the data at the moment is quite interesting. I think you know, we're sort of looking at increasing the global exposure. I think the US is running very high. I mean, we were talking about this at the conference the other day. We've got a huge amount of divergent views in the marketplace at the moment in terms of it. We were looking at, I've got a slide in another deck, I'm annoyed I didn't include, but we've got the same amount of information being presented to every asset manager in the UK in terms of what fundamental analysis is available. But if you look at balanced portfolios across the range, and I'll include this slide when I share the link, there's a huge amount of divergency. So some have 20% exposure to the UK, 80% exposure to the US, and on the other side of the scale, the same balanced portfolios have the absolute flip side of that. So it's, you know, it's 80 UK, 20 US, and the idea is that you know, there's a huge amount of speculation, again, in terms of how portfolios should be positioned. And what we're really seeing is that there is, you know, thematic trends starting to show themselves within the US equity market again, and that is really where a lot of the active selections are being made within AQ, and where we're starting again to get into a period of being able to add more consistent alpha and have more concentration to those themes after a period of more broad market exposure.
And in terms of how you guys are constructing these portfolios, you know, you've said it's volatility rated, the ability to tactically asset allocate. But what are we looking at? Global? You know, are there any biases in terms of, you know, is it truly data led, or are there any biases specifically around certain asset classes, certain geographies? You know, where do things sit?
Yeah, so there's
and this is actually just me being nosy now.
No, it's fine. It's good. I'm also imagining you being like surrounded by other people having their breakfast in in a Belfast hotel room. But
I'm not. I managed to steal a conference room.
So we don't have a house bias, unsurprisingly, but what you will see is, probably because we're taking more of a peer group view, that we have historically had a higher exposure to the UK, which isn't you know, a house bias. It's just the data set that is changing. So that is now becoming more global, and we are going to sort of create pure global focused range. It's launching next month for those that that do want a global bias.
This wasn't. I promise everybody, this really wasn't a prompt. I had no idea.
No. But yeah, there isn't a house bias. It's kind of just what it is, which is, you know, having kind of exposure and a slight tilt based on what the peers are doing, if you know what I mean.
And we talked a little bit about the tools that you guys are using, and obviously there are some firms out there, some advisors out there that have been building portfolios themselves for a number of years.
Yeah.
Who may or may not be using similar tools or whatever it may be. But you know, who are you talking to? As in, who are the clients that are coming to you and saying, actually, you know, we want you to do this for us? Is there a particular type of client, or is it a particular type of end client? You know, who are the firms that you're working with?
So we work with you know, quite a variety of firms, because what we do with this process is we kind of split it into two offerings. One is off the shelf MPS, and that tends to be quite popular with firms who've just had enough of the promises of tactical allocators and more old school views, and what they want is the clear reporting, to work with fund people like me, and to basically have something which is more consistent in terms of outcomes, and not going to make promises that it can't deliver. And so it tends to be people who've kind of firms that have had bad experiences of working with other MPS providers, really. Then on the flip side of that, what we have are our partnership clients who come to us saying, yeah, we've run models internally and they're great, thanks very much, but we are struggling with doing it efficiently, with coping with you know, the beast that it's become. And what we really want to do is work with you and your permissions to either look at a pure replication, or using elements of our sort of fund selection tool to say, well, actually start the process with this provider only. Our definition of good isn't 10%, it's 12.5. And what we do is we work together in a more consultative way to kind of effectively open up our engine and say, are there learnings that we can have that we can help you with? Are there things that we need to, you know, kind of adapt for your process? And we kind of create a partnership version of the AQ system, where we've worked together to evidence the goods, the bads, and the uglies, to create something that fits more with the firm. So, you know, we have those kind of two main client bases, really.
I've got a couple of other quick questions for you, but I'm just wondering if anyone else has got any questions. I haven't seen anything come in, but if anybody's got any questions that they wanted to ask you, or equally, if there's anything that you specifically wanted to share with people that we haven't covered, feel free to do it. I know you said we're not doing death by PowerPoint, and you've got some slides on another deck that you really want to share that you haven't got access to now. Hang on, I'm just looking at the chat. We've got a question from Hillary. Over what period of time are you considering these trends and allowed the data to recommend buy, hold, or sell? I used to use a fund that tried to do this sort of thing, and it adjusted its position on a monthly basis. All of the back-tested data looked amazingly good, but in real time, it just didn't work. It would just lock in falls in value and miss most of the potential recovery. I guess my question is, where does the short-term speculative movement become a longer-term target trend, and how do you judge this to ensure the data doesn't suggest a position based on prolonged speculation, for example?
Yeah, it's a really good question.
What a question.
What a question.
Hillary,
so
Hillary, I know Hillary. So Hillary, I didn't realize you had that in you, mate. Well
done. So the idea is, yeah, how do we kind of make sure that we are efficiently optimizing and grabbing a trend, you know, rather than just buying stuff that's about to bin. So what happens with AQ is, alongside the kind of core factors we're looking at, and we're looking at 3 to 5 year risk adjusted returns maximum, is that next to those core values, we have every fund's historical position within our league table for every value, so that we get a longer term view in terms of its consistency or its momentum. And momentum is one of the words that I hate using because immediately people are sick in their mouths. But the idea with momentum is that it's usually up the stairs and out the window in terms of what you're describing. But the idea is that if we can look at these trends, and we will look at short-term indicative data, as short as 6 months, but it's weighted within the algorithm to make sure that it's not flapping around. And we've taken very careful consideration into what a rebalancing frequency should be, because a lot of firms have picked quarterly just because it makes sense from a kind of I don't know, it's always been done this way and it makes it easier for us to create 4 reports. But really the most optimum rebalancing frequency from our testing is every 2 months. If you do it monthly, you're going to fly around, and the value that you add is incremental. It's for everything that you make, you bin off as well just as quickly. So you sort of capture it within this two month rebalance cycle, and you factor in the fund's consistency through momentum indicators, and that is what gives you the answer, and it stops you grabbing positions just as they fall.
Are you concerned that with this evidence-based investing and the use of AI, that actually, this could be run completely by a computer?
Yeah, I don't know. I mean, you could, in theory, run something like this. I mean, AI would be really, really cool at like enhancing certain features to make it. I mean, I don't know what you would do with it, to be honest. Like, because the AI is more perhaps, well, would it be helpful to have it generate some reports at the end? But there's the decision making that happens is really just there has to be a human trade-off with stuff like this, because you have to have the sense check. And I think, again, an AI really wouldn't add huge value to this, because what you would either want an AI to do is write a report in the voice of Donald Duck. I don't know, I'm probably being stupid, but like the AI advantages that come in, well, is there a way for us to use AI perhaps to write a change report or a client facing report in a quicker way? Again, we'd want to check that, because it's not really at a situation, and I don't think it will be, where it can take that away completely. We always want to have human sense check as part of it.
But I was going to say, I guess that's the point for me, is are we saying that yes, it's data led, yes, it's evidence-based investing, but actually it still needs a human overlay to look at this and understand the data to actually make those decisions?
100%. I think so. And I don't think you can emulate that with AI. I think there will be uses for it. And certainly you could feed some of this stuff into AI, and we've been tinkering around with it and see what we could do. But yeah, we're not there yet. I think I wouldn't be afraid of it either. It would just be a way of making what we do more efficient, but it would get to a point where you still need a person to stroke their beard and evaluate the outcome.
Well, I was just going to say, I think the only advantage is you wouldn't have to stroke Ash's beard.
Yeah, right.
Just very quickly then, if you were to summarize evidence-based investing, what, in simple language that either firms can take away and talk to their clients about, or start to talk internally, what is it? Because I've got my view, but I'd just be interested to know what yours is.
Yeah, I think evidence-based investing is just it's an approach that uses academic research, and it's typically more of a low-cost solution. So it's an approach that's based on strong academic research. It is typically lower cost, but is driven by data rather than speculation, or is not clairvoyant. And I think really something that's evidence-based should also be incredibly transparent, because there's no waffle in it. You should be able to understand exactly what it's doing at any point, because ultimately it's the expression of a kind of a data derived outcome.
You can tell which one of us is the intelligent one. So my take on this is, actually, it's nothing new. This is still it's a mixture of active and passive, but the data will tell you when to buy and when to sell, rather than trying to time the market based on speculation, or, as you say, and any active manager trying to beat the market all the time is never going to happen. This is literally a case of the data's told us to buy, we've bought. The data told us to sell, we've sold. Yes, we've missed some of the upside. Yes, we've captured some of the downside, but the reality is this is what we've, you know, the data's put us in this place.
Exactly, and if you can do that consistently, you'd be surprised, you know, how quickly that helps the proposition surface to the top, and how infrequently it falls. That's the idea.
Lovely stuff. If no one has any further questions, I'll just make sure there's nothing else coming into the to the chat. If no one's got any further questions, Paul, I've just seen you just put the a link in there, and you're going to share some of the slides, and including the slides that you've annoyed yourself for not having not having included. If anyone's got any further questions, individual questions they want to come back to me on, or the Verve Group on, or obviously to Paul, Jazz has just put Paul's details in, please give us a shout and let us know. But if there's nothing else from anybody else, I will say thank you very much, mate. I'll see you soon, and I wish everyone a good, what are we, Thursday? Yeah, good Thursday.
All right. Thanks very much, mate.
Wonderful. Take care.
Thanks everyone. Bye.
Bye.